Hello, listeners. Welcome back to another episode of Cognitive Dissidence. As usual, I'm your host. I'm Jacob Shapiro. I'm a partner and the director of geopolitical analysis at Cognitive Investments. Rob and I are back at it for our weekly chat on geopolitics and markets. I am not exactly sure what the cadence of the weekly podcast is going to look like for the next 2 to 3 weeks as we go into the holidays. I'm recording a bunch of episodes in the next week or two to give you guys some of those sort of weekly conversations that we post usually on Mondays. So just bear with us here over the next couple of weeks. We're going to get you content. It might not be on the same regular cadence that we've been expected, but we're not going to neglect you. Don't worry. Otherwise, we crossed over 90 ratings and reviews on the podcast on Apple Podcasts. I'm trying to get to 100 by the end of the year. I know from the podcast data that there are literally over 500 of you who listen to this podcast on Apple. So if you have 2 seconds, all you have to do is go into the Apple Podcast app, give us, well, I would love if you'd give us 5 stars, but just give us a rating, give us a comment if you really like us. It takes a couple seconds of your time, but it is hugely helpful for us. I really appreciate it. So with enough please from me, vive la France, and here is the podcast. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. All right, another week has passed, Rob. I'm not sure how I'm going to survive this one. It's Wednesday, and I still have 500 different things to do, but it's nice to take a break and talk to you for a bit.
We're here again.
Apparently, we've discovered the secret to nuclear fusion, and everything's going to be fine. There's going to be no energy concerns. Did you hear that?
Yeah, I think that's about as deep as the analysis needs to go. We can just leave it at that.
We'll just leave it at that. Let's just end the podcast right there. 30 seconds or less. What happened in the world? Yeah. We're gonna actually have like an expert come on in the next couple of weeks and talk about the fusion news. So don't think we haven't paid attention to it. If there's even a grain of truth to it, it's the biggest thing that's happened in the last 10 years, which is saying something. Like I'm cognizant of everything that's happened in the last 10 years. If we discovered the secret to unlocking nuclear fusion at a commercial level, like biggest thing that's happened in the last 10, 20 years, maybe ever. Like it's that big of a deal, but we'll get back to it. Why don't we just talk about the Fed and the inflation print real fast and get it out of the way, Rob, so we can get to the interesting stuff. I think people are paying somewhat attention to it. Although I saw even on Bloomberg, I had Bloomberg on in the background this morning when I was feeding the baby, and they spent more time joking around about soccer than they did about the actual print. So apparently World Cup fevers got people more entranced on at least Bloomberg than the print. But did you see anything in the CPI print or anything from the U.S. that you think needs noting?
Well, first of all, it's really hard to imagine how the World Cup could be more interesting than the CPI print and what we do for a living. just saying.
Also, I'm probably going to totally jinx myself here, but I know relatively little about soccer. I'm like starting to ramp up. Just want to say my bracket has Argentina v France playing for the championship. So we're recording before France-Morocco here. Watch this all blow up in my face, but I'm feeling pretty good. I mean, I always feel pretty good about myself, if you haven't already realized that, listeners. But I'm feeling extra good about myself today.
Which is funny because I have to say, we did the firm pool, and Jacob was in last place for almost the whole time. And I was thinking, man, this guy knows nothing about soccer. This is great. And I was in first place, and now my bracket's completely busted, and he's in the lead. So what do they say about blind soccer squirrels?
I don't know, but if you're trying to compare me, if you think this is all luck, this is a geopolitical skill right here, baby. I'm applying geopolitics to soccer. You can find me here for the next couple of years.
Well, maybe we'll be here a week from now when Jacob will be a little bit richer. But on to the real interesting stuff, the CPI print. So we're recording on Wednesday, just FYI. So the Fed meeting has not happened yet. The CPI print did happen yesterday. And I guess the only additions I would have, since everyone is commenting on it in every possible way, would be it's kind of really not much. So the CPI print itself came out slightly lower than expected, Whether the real expectations were for a miss of expectations, I think, we can always play that parlor game. I think probably there was an element of that. Markets were extremely tense heading into this. This is the biggest data point release, in the month of December before everything shuts down for the holidays. So volatility was bid through the roof. Everyone was positioned and watching this. And you can see that from the way the market reacted when the print came. Markets went bananas in all sorts of directions and pretty quickly reverted back to something closer to what they were before. The print itself showed that most of the disinflation is happening in goods, which really won't surprise too many people. The data on the important services sector, which is really where the wage inflation issue is centered, was much more mixed, and there wasn't very good data. We won't get into the nitty gritty details because it's probably beyond the scope of what we care about here. But there's really not much for the Fed to take away from that to say that the core thing that they're focused on, which is wage price spirals, labor shortages leading to, sustainably higher labor costs. There's nothing really to take away from here. So on the goods side, it's really not too surprising. Let's remind ourselves the inventory cycle is very much moving in the other direction now. So we talked about the bullwhip of the inventory cycle where everyone was desperate to get their hands on inventory 12 months ago, and there was shortages all over the place. Now everyone is glutted with inventory. No one's talking about the queues of container ships outside of Long Beach anymore because they don't exist. The price of shipping goods has collapsed because everyone's running down their inventories heading into the holiday season. I think the interesting thing to take away from that is even if that's the case and inventories are now high and everyone's running them down and the promotional cadence, as we say, basically how aggressive are stores in marking down prices to move product, the promotional cadence has increased again, given where we are in the cycle, given, that people are expecting a recession, you would have probably expected prices to be down more, promotional cadence to be even more intense than it has been. But it's been pretty muted, which is, I think, the biggest takeaway. Because as the inventory cycle turns back the other way, and after the holidays, businesses start replenishing their inventories, then you have a demand bolus coming back on the goods side.
Yeah, I've felt like for the past couple months there hasn't been a defined consensus or narrative, like we ping pong back and forth between CPI print this and this indicator that. I feel like for the last month, and it confirmed this for me when I had I was Bloomberg, I had it all on in the background, I was checking everything. It seems like everybody's talking, we're going to have a recession and we're going to debate the degrees of the recession, and then the Fed's going to pivot and we're going to go back to low inflation and low interest rates. That does seem to be the consensus. And I mean, we're not positioned that way. Obviously, Rob, you can say something about that. But it has been interesting to me the last 3 weeks to sort of see that view coalesce as the consensus, because maybe now, like, even if it's right or wrong, like just the fact that people are assuming that is what's going to happen to me is a little bit, I don't know, noteworthy. Is that the word I'm looking for?
Well, I guess you're not getting the sort of data you would expect to see if that were starting to really play out.
Yeah.
Aside from the housing market, which has started to really crack hard, you're not seeing much weakness. And we talked about CapEx and business investment and how well that's held up in last week's discussion. But even in housing, it's a really mixed, weird bag of signals here, because even in housing, if you look at the repair and remodel part of housing, that's still very strong. And in large part, that's because they're still working off the backlogs of work. I don't know. I know you guys have been refinishing your house and waiting for people to show up, waiting for goods to arrive. That has been still persisting, and that's expected to persist well into this spring. So, aside from people's demand for buying new homes, there's not a lot of massive weakness even in the housing market, which is the locus of weakness in response to the rate rises we've seen so far. So
yeah, we're mercifully done doing any work on the house, and I hope to never do any work on the house or any house ever again. But I will say, I stood up a little bit straight in my chair when you said that, people are trying to get rid of inventory and things like that in the cycle, because we were sold a dud freezer, and the company that sold us the freezer told us they don't even have an estimated date by which they can ship us a new one. So, I mean, apparently this company doesn't have a lot of supply. In the theme of Jacob doing field research, I can't remember if I told this to you on the podcast or told this to you at all yet, Rob. Did I tell you about the sip and dip? My experience at the sip and dip.
You mentioned mermaids, but just in passing. I'd like to hear more.
Yeah, well, so I was at this Montana Grain Growers Association, Northern Pulse Association event. Was that last week or either a week or 2 weeks ago? Time has lost all meaning for me. And after the event, I went to Great Falls' biggest attraction, which is this lounge called the Sip and Dip. Imagine a hotel, and there's a pool on the top level, and the level below that they have a bar, but the pool has a window into the bar. So if you're looking at the bar, you can see into the pool behind you, and they have mermaids, like literal humans dressed up in mermaid costumes, floating around in the water behind the bar. Why am I bringing this up? I asked them how much do they pay the mermaids to be in the water. It's $11 an hour, and then they get tips on top of it. But my point is, they had mermaids in the water. So if mermaids are making $11 an hour, probably I'm thinking there's not a lot of labor shortage in the market. Is that good field research?
Are you saying that you think mermaids should make a lot more than that?
No, I have no perspective on how much mermaids should make. Although I'm an equal opportunity guy. Everybody should make what the market is fair to bring. I'm just saying, if they can get mermaids into the water at 11 an hour in Great Falls, like, we should be able to find workers for all these things that people say they can't find workers for. Like something is not lining up correctly. Anyway, enough of my tomfoolery. Why don't we pivot? See what I did there? Into Rob was just like, Rob usually likes my corny jokes. Like the pain that came on his face when I made that one. I wish I could preserve that for you listeners. What you were mentioning, the euro was at an interesting sort of point from your perspective on the charts, and for me the euro has been interesting for weeks, and you've been kind of holding me back on that. So tell me what looks interesting to you when it comes to the euro.
Well, the euro looks, or to be more precise, the dollar against the euro has behaved much the same way like we described Chinese equities last week, where it was Chinese equities were massively oversold. And then with this reopening trade, they rebounded very, very sharply and are now back to where you would expect that rally to fail and the original downtrend to continue. Well, the euro looks fairly similar. So earlier in 2022, the euro broke through a very important level that it had maintained for years. And now we've rebounded basically back to that level. And the background to that is, sentiment toward the euro is very, very positive now. Like if you look at the Commitment of Traders report, which shows the speculative futures positioning, the long position in euro futures by speculative traders, not commercial hedgers, is as large as it's been in the last 10 years, which is really surprising how everyone's kind of jumped in on this long foreign currency trade, short the dollar, the Fed pivot, let's get ahead of it. Let's be long currencies and short the dollar. So the euro is at a very interesting testing point right here, because if that downtrend is indeed going to continue, if that break of that key level earlier in 2022, right when sort of the whole narrative around inflation and rate rises changed and people began to realize like, oh shit, they really mean what they say about squeezing this out of the system. If that's valid, you would expect the euro to fail here. And that's what I'm watching with a lot of attention. I wouldn't be bullish on the euro until it can really show that it can dig in, digest this gain, and move above that key level of where it had been. And that gets to, what we were talking about with CPI is CPI missed. Not much has happened. The 12-month Treasury yield is where it was in October. A lot of key indicators are sort of treading water. So the market itself is giving mixed signals. But on the euro, I think you'd have to say the risks are skewed to the downside rather than to the upside, just given where it is currently. And if it can't break that on decelerating inflation, then that's tricky if you're bullish.
Yeah, I think it's been a fairly good week for the European Union, though, news-wise. I mean, last week we were talking about Hungary and its recalcitrance, and Hungary basically had to wave the white flag. I mean, they're going to try and spin it as a win for Hungary. I saw Politico actually said it was a win for Orban. I don't see how it's a win for Orban at all. Hungary had to give up blocking the European Union's aid package to Ukraine. Orban himself was literally tweeting, "We don't want a common European debt union, and that's what this aid is going to entail." Apparently, objections out of the way, dropped objections to the global corporate minimum tax, and still didn't get all of the funds they were supposed to. And a lot of the recovery funds are still tied to progress on certain issues related to corruption and judicial reforms and things like that. But they reached a deal. Like Hungary basically had to wave the white flag, and we've been debating it a little bit internally. I think part of the issue here for Hungary is that this whole thing about I think the common debt argument would actually be more powerful if it was targeted against anything except Russia. But when you're trying to say we shouldn't send money to Ukraine to fight Russia because we're worried about common debt, for the first time, Orban does not have his finger on the pulse correctly there, because first of all, Poland is going to say, get out of here. Like Russia's a threat. You're now playing around with the thing that is existential for us. You're not going to have our support in the European Union. You're basically going to have no support in the European Union. Nobody's backing Hungary up with that. So I don't think Hungary is suddenly going to behave and do everything the European Union wants, but I think Budapest really has to reconsider its tactic there, because even being seen even sort of in an indirect way as supporting what Russia's doing, I really do think there's been a true change in the European mindset there, and that's just not going to work.
It's funny because we've been talking about Europe for a long time and expressing sort of our bullish thesis on it. And I think, as you point out, this is a modestly positive data point for that thesis. I think fairly supportive, not huge, but it's not against the thesis, that's for sure. And for much of this time, we've sort of assumed that bullish, EU thesis and consolidation is necessarily bullish for the currency. And I wonder about that, we talked a few weeks about sort of the differences between the Fed and its motivations and the ECB and policymakers in Europe and their motivations. And I wonder if you can have simultaneously a very strong EU and a rising EU, and an EU that's investing aggressively to do what it needs to do from a military, from a new energy, from a technology standpoint, and yet have the currency and interest rates remain fairly muted, because that's what they want. The EU has always been more mercantilist in nature than the US has been. And they seem to be making some noises where they don't really want interest rates to be too high, because they don't want to squeeze the household sector. They don't want to squeeze labor. They don't want to create a recession. And I think that may outweigh some of the other factors that the Fed is more concerned about. Yeah,
and I hadn't actually thought of this, but that also, to your point, a weaker euro should mean good things for German and other exporters. And everybody's talking about how European companies and German companies are going to lose their competitive edge because of the energy crisis. And I think we've, beaten that horse to death. But if you're going to have a weaker European currency than you're used to, then maybe at least you're going to make up some of the difference in the drop in competitiveness while they pay higher energy prices for a year or two. I will say I've been working on our sort of forecast thoughts for next year. And I think this, I've already sort of put the draft in, and I have in the draft. I think this is the make or break year for the forecast on the European Union. I've been talking about it for a couple of years. We've been talking about it since we got to know each other. I think we need to see some real progress this year, or I need to sort of revisit things. We need to see Europe throw a lot of investment at energy so that it's not in this situation again. We need to not be dealing with petty political arguments with Hungary and Poland kind of after this in the year. We need to really be talking about European enlargement into the Balkans, maybe even Ukraine. You want more countries, more markets into the European Union. That's how that's got to work. I do think it's going to be a pivotal 6 to 12 months for the European Union that's going to tell us a lot about where this goes going forward.
Yeah, agree, for sure.
Before anything else there, before we venture elsewhere?
No, let's go to China and semiconductors and COVID, because there's a lot happening there that I think it's worth getting into.
Yeah, there's a lot to unpack. Well, where do you want to start? We could start tangentially on what we were just talking about with the news about the Netherlands and Japan maybe signing on to semiconductor restrictions, but maybe you want to start elsewhere. What is the most important thing you think with China this week from your perspective?
Well, let's start with markets as a framing mechanism, and then we can get into sort of what's feeding into that. Mm-hmm. So after this, we spoke last week about Chinese equities making this rally, and this is where you would expect them to stall out. And they have indeed stalled out. So the last 2 weeks, Chinese equities, whether in Hong Kong or in Shanghai, have sort of moved sideways. At the same time, bond markets are getting absolutely slammed in China right now. So short-term yields are rising again very sharply. And the consensus view seems to be, so if you read on Bloomberg this morning, it says that people are selling their bonds, households are selling their bonds through these wealth management products. So they're redeeming wealth management products, and they claim that they're putting all their money into equities, which I don't know if that passes the sniff test, because equities are not going up simultaneously with bond yields blowing out. So it's a bit of a mystery, but it's sufficiently concerning that the Chinese government has requested banks to step in and try to support the market. So that hit the newswire just this morning. So something is happening there where people are spooked about wealth management products, maybe, but they're certainly redeeming them. Certainly bonds are selling off hard. And maybe the optimistic view is that people are anticipating reopening, they're moving into equities, but that doesn't feel right. And I don't know exactly how to explain it, but it's worth putting it out there as something that's a bit of a puzzle.
Yeah, there's just a lot of uncertainty with China. I mean, I was really hoping to get some developments from the Chinese. I forget what the meeting is called. It's the Economic Work Conference or something like that. It was supposed to be a big meeting for planning Chinese economy this week. They postponed it due to COVID cases in Beijing. And last week when we were talking about this, we thought that maybe that would be the place where we would start to get some demand side stimulus maybe out of China. There were even some whispers and reports that was sort of the situation. We did get this, also this morning, Xinhua published a new 12-year plan, I think just the opening of it. We don't get any of the actual details or the subsequent chapters, but it sort of released the first part of the plan. As an aside, I never understand these communist countries where we've got this 5-year plan and this 12-year plan and this 7-year plan, and it's really hard to sort of keep track of all the different plans and what they're going to say. But it was interesting because this 12-year plan is supposed to stoke domestic demand. It sort of at least targets the things that we've been saying should be targeted if China does want to make this transition. No details about what, when, and obviously it's a 12-year plan, so probably no immediate relief.
It's a pretty long plan.
Yeah, even by sort of Chinese communist Leninist with Chinese characteristic standards, 12 years is a pretty long time to sort of be talking about those sorts of things. I also, it probably isn't this, but I wonder if it's an admission that their plan out to 2025 is just not going to work. And this is where the semiconductor stuff comes in. I mean, I think maybe she was a little ambitious about what China was going to be able to do to 2025. And by the way, ambition's not bad. You need people to set ambitious goals if you're going to achieve things. Like Kennedy in the space race is a great example of this. When Kennedy first announced we're going to the moon, everybody was, most people thought he was a lunatic. Nobody thought that was actually possible, but it stoked all of this innovation and things like that. One of my big complaints about US politics is that we've gone from making those big grandiose promises to a really narrow frame of what we want to do as a society, and your performance goes down. Anyway, I went off on a tangent there a little bit, but yeah, just to say that China sort of realizing it can't do a lot of the things that it thought it was going to be able to do out to 2025. And you can see them changing their behavior. You can see them trying to soften a little bit with the United States, trying to be a little bit more diplomatic. And it's not working. Like, I think the White House came out today and said they're going to blacklist 30 more Chinese companies. The U.S. is pressuring the Netherlands and Japan to come on board with these semiconductor restrictions. The reporting is that the Netherlands, or that the Dutch and the Japanese governments have agreed, but I saw an ASML official came out today and was criticizing it. So, like, if the Dutch government agrees, but ASML is pissed off, like, that's an interesting sort of, government versus company clash there too. So yeah, I mean, there's a lot to kind of unpack there, and I'm with you. There's more uncertainty than certainty when it comes to China, and I take a weird view at anybody I saw Deutsche Bank. I think we talked about last week, was being optimistic about the property sector. I saw Goldman had a big thing this week about oil demand from China reopening. All this stuff is going to be great. Maybe we get back to real growth at the end of the year. It doesn't seem to me that you really have much to hang any of that analysis on that is empirical or verifiable or fundamental.
I guess two comments. The first would be, they've been talking for really a long time, almost 10 years now, since around 2013, very openly, and in some ways going back to 2008, about the need to rebalance the economy away from investment and toward household consumption, and find that equilibrium that's been missing for so long, which is why they're on the treadmill to hell. They so far have not been able to accomplish that at all. They've not rebalanced the economy at all. And in fact, it's gotten worse in the last year. So the debt to GDP ratio in China is up another 13% over the last year. So we'll see what this 12-year plan says and whether it meaningfully, changes anything. But the fact remains, until they are ready to really wrench, the heart out of the existing economic system, you're just not seeing it. And they're just going to make the problems worse, which is what they're doing. The other thing just to observe is on the semiconductors and sort of, industrial policy, and I saw there was a piece saying that they're expected to release a 1 trillion won subsidy and tax credit program to stimulate investment in semiconductor equipment by private firms and semiconductor research, just basically throw money at trying to move up the technological frontier and get to where they need to be. That's a really tough thing to do now. Like, if you look at the Japanese model, the Korean model, the Chinese development model, they're all predicated on the fact that you have discipline. So the government retains a very firm hand on where the capital is going. And the reason those models were always successful in all three cases was because they had the discipline to cut off those who were being wasteful, regardless of how politically connected they might be, and allocate capital into areas that are actually getting traction, where they're improving their competitiveness, where their export market share is growing, and they're putting the capital to good use. Like, the horse has fled the barn in China on that a long time ago. They've been throwing capital, whether it be in the property market or various other infrastructure, high-speed trains that don't return even their operating costs, never mind their financing costs, that sort of thing. They've been throwing money down that hole for years, and now they just have much more limited space to maneuver. This is 143 billion US dollars that they're throwing at semiconductors. Man, they better hope that gets traction, because that's going to be more money down the hole. And every year, debt to GDP goes up, 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 up. And they'll have to be very skillful to make this work.
Yeah, I have a couple things to say in response to that. First of all, my semi-regular plea to Chinese intelligence officials who I hope are listening to this podcast: if you want to build some of these unproductive high-speed trains, come to the United States, build them across the U.S. Southeast. You can build wonderful trains. We'll default on the debt. You'll have built things. We'll have high-speed trains. I'll be happy. Everything will be great. Please. Thank you. Appreciate it. You also you mentioned the sort of semiconductor thing and the big stimulus. And there was a couple of things I wanted to break apart there. The first is, and I didn't say this originally, Japan, the Netherlands, the U.S. has put pressure on them. The country that nobody is talking about in the context of that is, where is South Korea? And South Korea, with a government that is nominally more pro-U.S., although they won sort of by a very small margin, playing both sides there. And South Korea is a semiconductor powerhouse in and of its own right. I've talked for a long time now about how South Korea, if you look at the grand swath of sort of Asian history, South Korea generally tilts more towards China. The last 75 years is an aberration and really has more to do with this weird anachronism of the division of the Korean Peninsula, a hangover of the Cold War. It's South Korea and the Philippines, the places that I'm most interested in terms of where China's going over the next couple of years from a geopolitical perspective. It's not Taiwan. It's not Hong Kong. It's really, can China make any progress with South Korea and the Philippines? Can they get them from staunch U.S. allies to reluctant U.S. allies or even to neutrals? So I thought it was interesting that South Korea doesn't even seem to be in the conversation about the semiconductor restrictions. To your point about sort of throwing money at the problem, the best example of this is actually Huawei, which Huawei was not the Chinese government's chosen champion. I think ZTE got more in terms of direct subsidies and support from the Chinese government. I can't remember ZTE or some others, or maybe it was all the others got more than Huawei combined. But Huawei was this interesting company where it took advantage of the macro environment in China, but also competed on the global stage and outcompeted companies like Nokia and Ericsson and some of the ones that were making this 5G tech, to the point where they were making the best and the cheapest gear in the entire world. It's one of the weird things about the U.S. going after Huawei. It was sort of, you went after this thing that was emblematic of what you actually wanted to happen in China. The example of markets changing Chinese behavior, Huawei was the seed, and you just kind of knocked that right out from underneath it because you thought the Chinese government was going to take advantage of that. They might have, by the way. It might be the right security decision, just pointing out sort of the dissonance there. And then the last thing I'll just say is that Cousin Marco had a fairly long tweet thread this week that kind of stopped me for a second, because I do think we're throwing around, semiconductors and semiconductor dominance and, oh my God, the cutting edge. You don't need the cutting edge semiconductors to make most of the things that power the economy. Now, if in your plan for 2025, you're talking about being a global leader in artificial intelligence, yes, you're going to need the advanced semiconductors. That's why I say maybe Xi got a little bit ahead of himself and didn't think that China was going to be cut off from global semiconductor supply chains as quickly as it has happened. But I thought Marco made a good point, which is that China can make a lot of the things that they need for the economy to keep going. Now, they can't push to the commanding heights of technological, whatever the flowery language she was talking about. But just because they can't, bring in ASML's new, lithography machine so they can have 3 nanometer or 5 nanometer chips, doesn't mean that they can't sort of make the chips they need for the economy to function, for the Chinese military to continue accelerating. So I think that's also an important thing to note here, that I wonder how much advantage the United States is actually getting by cutting China off in this way. And you're right that it's really, really hard to develop these ecosystems, but now China has a reason to. So they're at least going to try, whereas before they weren't going to. It's sort of the flip of China makes or processes a lot of the rare earth elements that are used in technology in the world, and has for sort of the last decade or two. And in the early 2010s, used that as a cudgel against Japan when they were having some territorial spat. And it was bad for Japan in the short term, but then Japan decided, okay, we're going to have to reduce our dependence on China. And it was a really good example of that sort of leverage being most powerful when it's leveraged, not when it's actually used, because when you use the leverage, the country that you're using the leverage against decides that it wants to act differently. That's what the United States has done here. It's burned the semiconductor card. So maybe it will take China 5 years to get back up to where it could have been, but China's going to make that a goal. They may not succeed, but I think that's another of the big shifts here that we have to take into account, even if it is unproductive money.
I think that's something that China has shown itself in many ways even more effective than Japan before it, which is getting to the technological frontier in a lot of these areas. Like look at autos, for example. Autos is historically one of the most difficult things to get right, because always, even before EVs, autos combine industrial prowess with consumer know-how. You can make a car, and if it looks like shit, no one wants to buy it. And if it doesn't run well, no one wants to buy it. And combining those two skill sets is extremely difficult at scale and, at razor thin margins globally. And China is a remarkably strong competitor in autos. In fact, if you look, the market share growth that China has taken in Europe in the auto sector has been really impressive. And on the EV side, that market share is set to accelerate in the next few years because China has developed this commanding lead in EVs in Europe. So like you're talking about something like 30% of all European new car sales could be from Chinese brands in the next 5 years, which is huge.
Yeah, it's funny you say that because I'm having John Minnick on the podcast. I'm recording with him later today, but the episode won't appear for a week or two. And I read his most recent paper and we're going to talk about it more in depth. But he actually talks about the different industries where China has been able to ascend global value chains, and he talks about how the automobile sector is the shining example of what China's done. And to paraphrase his basic conclusion, the reason that is because China can steal or coerce a lot of the tech know-how behind it and not face any consequences. Because stealing how to make a car doesn't mean you're going to successfully invade Taiwan. Whereas semiconductors, which were designed to make more, I say this point all the time, like they're literally at the heart of the U.S. defense industry. They were designed to create more accurate missiles. China doesn't have the leverage there. They also don't have the type of market that you can kind of leverage there. The top consumers of those top-end semiconductors are not necessarily the Chinese market, whereas cars kind of are. So it's an interesting dichotomy where China can very quickly assimilate foreign technology that is not considered crucial, whereas it has not been able to replicate a domestic semiconductor supply chain because even in an era of globalization, the United States and these different countries were not willing to cede their intellectual property to China and protect it relatively well against China's attempts to take it.
Moving away from semiconductors for 1 second, because everyone talks about semiconductors all the time.
Everyone's a semi-expert now.
Yeah, computing is just, everywhere, and we hear about it ad nauseum. One of the things that we're going to be talking about much more in 2023 is geopolitics plus innovation. And stay tuned because there's going to be a ton on that. But within that, one of the concepts I think we're going to be speaking a lot about is this notion of general purpose technologies. So technologies where the underlying element of the technology is getting exponentially cheaper, and it's being used more and more widely. So computing is the prototypical example of this. Moore's law, the whole bit. Everyone knows that. The other one that no one is talking about is genetic analysis. So talking about what China has done successfully, are they going to get to the cutting edge in semiconductors, whatever? Look at genetic analysis. So the big, this is, again, because we look at companies all the time, this is why we are looking at this. The big gene analysis, the company that makes the machines in the world, in the US, but they're globally dominant, is Illumina. Not in China. The company that dominates there is called Beijing Genomics. And this is a really interesting test because Beijing Genomics, for the first time next year, is going to be entering the US market and non-Chinese markets. And the scuttlebutt is that their machine is pretty darn good. So the fact that they can get up to the cutting edge in that area, I don't know enough to know how they achieved that, but it speaks highly to their ability to do it elsewhere.
Yeah, I'm glad you brought that up too, because like the semiconductor story is now dangerously close to being over. Like it's still going to continue for a long time, but like I said, the U.S. has burned its card. We all know what's going to happen. Like the trajectory is kind of clear. It's going to be really interesting to see as sort of dual use technologies, whether it's biotech applications, space and aerospace applications, agritech and agriscience applications. Like those are the sectors I expect this to expand to from here, and are the ones that nobody's talking about, and the ones that I'm trying to read up on now, so that when we get to the point where those things start to tighten up, we're not armchair experts on it. We're actually kind of building expertise there. So I think that's a really good point. And it's actually somewhat surprising. I mean, China's got sort of a mixed bag with that. Like they tried like heck to create an African swine fever vaccine for their pork herd, couldn't do it. We're desperately searching for it. The US and Vietnam have managed apparently to come up with one on their own. China still doesn't have a very good mRNA COVID vaccine, although they do apparently have the first vaccine that goes like a nasal spray vaccine or something like that. So they are making sort of advances in different ways there. So I think you're right, though. Like I've said, it's space, biotech, agriculture, I think, are the big kind of competition grounds that nobody's paying attention to in the decade ahead. And that might be the next one. We already saw it a little bit around COVID.
Do you want to speak about Southeast Asia a little bit? Because you had seen some things in the news, and we could speak about how the charts look like
let's
garbage.
just do a couple minutes on it, because I haven't done enough to really say that I have strong conviction here yet. But we talk a lot about the economic problems in China. Vietnam's having a lot of the same economic problems. Their property sector apparently resembles the Chinese sector in many ways. You've got sort of liquidity concerns there. The Vietnamese government coming out and worried about bonds and clash. I saw there was some clash with Amazon too, and a lawsuit pending. Vietnam was sort of the darling of the first stage of deglobalization and nearshoring and get away from China. And it seems like that narrative is breaking down a little bit, and that the Vietnamese economy is breaking down a little bit. And there's a big difference between China and Vietnam, in that China is governed by Xi Jinping, authoritarian emperor, president, general, whatever title you want to use. Like the yuan stops with Xi Jinping in China. That's clear. He's eliminated all of his rivals. Vietnam doesn't have that. Vietnam kicked the can down the road on who and which factions were going to be the ones that got to author Vietnam's versions of the next 5-year plans and 12-year plans and things like that. And they've got a really older guy who is going to continue as the main leader behind the scenes, because they couldn't figure out who was going to go next. So my point there is, you don't have the kind of political stability and the kind of centralized power in Vietnam right now today that you do in China. We're probably going to see that happen over the next couple of years and see which kind of faction emerges. So you put all that together, that concerns me. And then, a little less concerned about Malaysia, a little more concerned about Indonesia. And Indonesia is sort of the sleeping giant that nobody talks about, country of over 200 million plus people, right astride all these critical sea lanes, has really led the charge towards protectionism. I mean, they've been trying to get Chinese companies and other companies say, if you're going to be here, that means we want you to vertically integrate here. We don't just want to be a cog in the machine, and we're not going to export our mineral commodities abroad. We want to process them and refine them and use them here. Like, they've kind of been ahead of the game there on protectionism from that front. But you also have social issues that seem to be emerging there too. There was a suicide bomb somewhere in Java. You've got this new law that they say that it's not going to apply to foreigners, but that if you're Indonesian, you have to have proof that you're married before you can stay at a hotel. Like the sort of clash between traditionalist values versus modern values and how that's going to play out in Indonesia. They also have an election coming up. So those are just, for two very different reasons, two countries that kind of popped up on my radar this week, and which I'm going to have to review pretty closely in the next week, because both of those set my spidey senses off in a bad way. I think you want to talk about the charts, because when we talked about this a couple weeks ago in the context of our strategic wealth strategy, you said the charts look like crap, if I remember correctly.
Yeah, that's essentially the story. Whether you're looking at Vietnam, Thailand, Indonesia, Malaysia, we see nothing positive in any of those charts. They're just bleeding out. In contrast to many other emerging market charts, God forbid you mentioned Australia, which is on fire in the same region, but obviously extremely different from an economic standpoint. So I know it's hard to take individual countries in a region and kind of move to the higher level and speak about what they have in common. But if you were to lump Southeast Asia into a group and consider how they're sort of positioned between China, the US, to a lesser extent Australia, what do you think what is your net assessment, I guess, for the next 5 or 7 years? What are you focused on?
I'm not going to give you the net assessment because I haven't done enough of the work, but I'll tell you, let me give you a working thesis that I will poke holes in, and we'll come back and discuss it in a couple weeks. And I think you hit at least one of the points that I would make. It's generally not good if you're a region that is caught in between powers in a world where there's geopolitical competition. So you don't want to be the chessboard that the great powers outside of you are moving the pieces on. This was the Middle East in the 70s and 80s. We might say that part of the reason the Middle East is so fucked up is because the Soviets and the Americans, that was one of their favorite playgrounds for how to kind of work, for how to fight the Cold War without actually fighting each other. Of course, Southeast Asia was one place where that happened too, but that really wasn't the Cold War. That was a U.S. mistake in Vietnam. We thought Vietnam was part of the Cold War. It was really a war of independence. And anyway, we don't have to go down that rabbit hole. So that's one thing about Southeast Asia. It's at the forefront of competition. And I'm more worried about a country like the Philippines, but in the whole region is there. And this is the second point I would make. It goes to the sort of idea about emerging spheres of influence. If we do sort of have emerging spheres of economic and political and military influence, and if China's economy sucks, it probably makes sense that the economies that are most exposed to China are going to be doing badly. So even though countries like Malaysia, like Vietnam, are really oriented towards the West and don't want to be aligned with China for a lot of different reasons, each one of them has their own reasons for it, but none of them really want to be in the Chinese camp. But they really don't have any choice. Like, China is the economic engine, not just for the world, but especially in that part of the world. So if the Chinese economy is going to do badly, Southeast Asia is probably going to do badly too. And maybe you're seeing those linkages show up directly. Maybe that's a real tangible sign that, hey, Southeast Asia is a lot more plugged in to China than maybe the rest of the world, because the rest of the world, the United States is not doing that badly. Southeast Asia is reflecting China. It's not reflecting the United States. The lone exception, before I say the lone exception, I should also say this is why I like countries like Brazil, like Turkey, even like South Africa. These are countries that are far away from the geopolitical competition zones, or are powerful enough to assert themselves within competition zones in the case of Turkey. These countries in Southeast Asia are not powerful. They're at the center of all these things. They have a lot of different risks that a country like Brazil, like Mexico, like South Africa don't have. Now, they have a host of their own domestic political problems that you have to talk about when you're analyzing them geopolitically, but they're far away from the chaos. And that's one of the reasons that's the profile of the type of country that I like. The one exception in Southeast Asia that I would just put at the top of our minds is Singapore. And I think in our research call the other day, I described it as the bar in Tatooine in Star Wars, where literally everybody's there. Like, that's at play for Singapore right now. They could become the Hong Kong of the next 20 and 30 years because they are small enough to where they're not threatening to anyone. There's connections between West and East, and specifically with China, but also with their colonial past and all their institutions back to the English-speaking world. And they are right astride those global sea lanes. So there's a real potential for Singapore to emerge as this sort of global financial economic center where everybody from the smugglers to the Jedis to everybody else is going to be coming through their bars and putting their money through their system and things like that. Singapore is more of the profile of the type of country, or really city-state that should do well in this kind of environment versus manufacturing economies in places like Vietnam, Cambodia, etc. But again, that is a working thesis. I might come back in 2 weeks and tell you, hey, that was really good thinking on the fly, but it's all bullshit. So don't hold me to that. That's low conviction right now.
Yeah, man. Everything is a working thesis as far as I'm concerned.
Except my World Cup predictions, which you might as well call me Nostradamus over here. Let's close out, Rob, on maybe just a couple thoughts on grain in general, and specifically on Argentina. So it looks like the triple dip La Nina is going to persist a little bit longer maybe than people thought. So the latest report I saw was until the end of the Northern Hemisphere winter and the Southern Hemisphere summer. And then maybe we'll get back to more neutral. And I think the report I saw said 75% chance that La Nina will persist into February, and 60% chance that it could even persist into March. And the reason I say that is because we're seeing that show up in Argentina. The weather sucks in Argentina. They are marking down their yields for things like soybeans and corn significantly. And I'm beginning to worry about Argentine production in general. The good news is that Brazil seems to be okay. The weather seems to be largely focused. The hot, dry weather seems to be focused on Argentina. They've also had a little bit of rain sort of in the last week. So maybe this is all much ado about nothing. I just, for the last 2 years, I've been talking about higher food prices, and I got that right. And this year, I'm not sure. It's really on a knife's edge. If you get sort of a worsening of the Russia-Ukraine war, some Black Sea blockages, if La Nina does go to March instead of February, if we get more use of soybeans and corn and biofuels, like you put together a couple variables, I can very easily make the case for another high year, unprecedentedly high here on the back of two already high years with food prices. I could also see, you can also make the, hey, like recession, Chinese demand falling off of a cliff, like Black Sea's fine. There's going to be some kind of agreement with Russia, Ukraine, even if there isn't, grain is coming out of Ukraine. Like you can also make the case the other way. But I have, on a topic that I had a lot of certainty over the last 2 years, I have a lot more uncertainty kind of going into this year. And you can hear the ambivalence in how I'm talking about it. Like I can't decide which of the narratives I like more. But the one thing I can say is Argentine agricultural production looks terrible because of the weather. And that you should at least start focusing in on grain prices and sort of global food prices in the next 3 to 6 months.
I guess the only thing I would add is just channeling an internal discussion that we had in our weekly macro review last week. In many ways, I think you have to look at grain markets and start with just the base rate, right? So the base rate is they're very volatile, and sort of price signals create a response. So you spoke about a lot of very particular factors, Argentina, La Nina, how long is it going to persist? It's really hard to know what all of those things are going to do. I don't think we're equipped to know, if anyone is. But like, I think that has to be against the background of, hey, the base rate says that we just had an enormous spike and a lot of things are going to be responding to that spike. So if you look historically, even if you assume grain prices are going to remain elevated on average for a very long time, for the next 10 years, we're very likely to have huge swings within that, because grains and commodities in general just don't work that way. You don't just hit the higher plateau and you stay up there. Almost never, because they do have supply responses that work in both directions. So,
yeah, I'll push back a little here and play a little devil's advocate, which is to say that's a version of the argument that that is the global consensus around interest rates, which is that we had this unprecedented inflation and we're raising interest rates, but eventually we're going to go back to the way that things were before. And I think you're right. Like we really haven't seen like an enormous, like a spike on top of another spike in terms of food prices. But one of my points has also been like global food trade and grain trade is going through like the most fundamental change it has in over a century. So I think you're right that if you're just looking at history, it's very unlikely that you had that big spike last year that you're going to have another spike on top of it. I guess what I'm saying is there's enough uncertainty out there that I don't think that's a crazy argument to make. I wouldn't just say that, because we're because this hasn't really happened before, then it might not happen next. It's probably not even the most likely scenario with this case in my mind, but it's there in a way that it wouldn't have been before, if that makes sense. That wasn't very articulate, but
oh yeah, and I'm not saying it's a crazy scenario at all. I mean, that could very well happen. Maybe that's a 40% chance. I don't know. All I'm saying is, I think rather than get lost in trying to anticipate all of the sort of cyclical factors and little odds and ends that go into driving grain prices, like you should start with that framework as sort of your base case and then modify from there. And if you hold on to that, it's probably a better approach than getting too focused on the short term.
Unless we need a new base case.
Yeah, I think that's valid. Did something change in the historical ways that these things work, which is totally plausible given demographics, given weather? The climate has changed, I don't know. So in short, we don't know anything.
I wouldn't say that. Well, at least we sound intelligent while we do it. So I think that was a good roundup. So I think we'll kind of keep it there. Rob, are you rooting for France now that you're a recent French resident?
Boy, that's hard. I do root for France generally. I think it's really hard not to want Morocco to pull off an upset because it would be just incredible. I'm a big Brazil fan, so I do not want Argentina to win, but I find it hard to root against Messi.
Yeah.
So putting it all together, I'm sort of a neutral.
Okay. Well, I'm obviously in the camp for. I think France is going to win in my bracket, so
I've seen your bracket.
Yeah. Well, the listeners haven't, so I'm just dropping little nuggets here. I'm taking a victory lap before the victory lap, but I feel pretty good.
Well, we are recording on Wednesday, so when Morocco pulls it out, we can revisit.
I'll have egg on my face, and you can come back and tell me how wrong I was about everything. So, all right, we'll end it there. Cheers. Thank you so much for listening to the Cognitive Dissidence podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur.